At its peak, WorldCom wasn't just another telecom company, it was a giant. It was the second largest long-distance phone company in America, rivaled only by AT&T, and it controlled a vast network that spanned the globe. Investors saw it as a gold mine. Wall Street analysts sang its praises, and its CEO, Bernard Ebbers, was hailed as a visionary. But behind the scenes, WorldCom was crumbling under the weight of lies, fraud, and desperation. In one of the largest accounting scandals in United States history, WorldCom's house of cards came crashing down, costing investors over $180 billion and putting 30,000 employees out of work. This wasn't just corporate misconduct, it was a massive betrayal of trust that forever changed how America looked at big business. Let's rewind to the early 1990s. The telecommunications industry was exploding. With the rise of the internet and deregulation, there was a rush to build global networks and dominate the long-distance market. Enter Bernard Ebbers, a former basketball coach and motel owner from Mississippi. He co-founded a small long-distance reseller called Long Distance Discount Services Incorporated, later renamed WorldCom, and through a bold acquisition strategy, turned it into a behemoth. Under Ebbers' leadership, WorldCom went on a buying spree. Between 1995 and 2000, it acquired more than 60 companies, including MFS Communications, Brooks Fiber, and most notably, MCI Communications for $37 billion in 1998. This MCI merger made WorldCom the second largest telecom company in the world. On paper, it was a success story. Revenue skyrocketed, stock prices soared. The company was valued at more than $180 billion. But while the outside world saw WorldCom as unstoppable, internally, the company was already beginning to show cracks. After the dot-com bubble burst in the early 2000s, telecom stocks took a nosedive. Demand for long-distance and internet infrastructure slowed dramatically, and with WorldCom's growth entirely dependent on acquisitions and constant revenue increases, the company began to falter. But instead of admitting that growth was stalling, executives chose deception. Between 2000 and 2002, WorldCom's senior management, led by Chief Financial Officer Scott Sullivan and sanctioned by other top executives, engaged in a massive accounting fraud. The heart of the scheme was actually pretty simple. They improperly classified expenses as capital investments. In normal accounting, operational costs like network maintenance or leasing fees should be reported as expenses, something that reduces profits. But by moving these costs to the capital expenditure column, WorldCom made it look like they were investing in assets, thus keeping their earnings artificially inflated. This accounting sleight of hand wasn't just a rounding error, it was a full-blown fabrication. By the time it was uncovered, WorldCom had fraudulently inflated its earnings by over $11 billion. That's right, $11 billion in fake profits. The fraud was hidden deep in the company's internal records. Only a handful of top executives knew what was really going on, and those who questioned the numbers were often ignored or silenced. The company's internal audit systems were weak, and external auditors failed to dig deep enough. Wall Street remained confident, and for a while, the illusion worked. But by 2002, the pressure was mounting. WorldCom's debt was ballooning, and investor confidence was starting to waver. Then came the beginning of the end. A low-level internal auditor named Cynthia Cooper and her small team started noticing discrepancies in the company's books. When she began asking questions, she was met with resistance, but she persisted. What she uncovered shook the foundation of the entire corporation. Cooper's audit revealed that billions of dollars in line costs had been reclassified as capital expenses with no supporting documentation. She brought the findings to the board's audit committee, and the truth finally came out. On June 25, 2002, WorldCom publicly admitted to misstating its financial statements by $3.8 billion. That number would eventually grow to more than $11 billion, but even the initial revelation was catastrophic. The very next day, the company's stock price, once trading at over $60 per share, plunged to pennies. Investors lost billions overnight. Just 1 month later, in July 2002, WorldCom filed for Chapter 11 bankruptcy, the largest corporate bankruptcy in American history at the time. More than 30,000 employees lost their jobs, pensions were wiped out, shareholders, including major institutional investors and everyday Americans with retirement savings tied up in WorldCom stock, were left holding worthless paper. Confidence in corporate America took a nosedive. The media called it Enron, Part 2, and once again the public was forced to ask, how did this happen? Investigations began immediately. The United States Securities and Exchange Commission, or SEC, charged WorldCom with fraud. Congressional hearings were held, executives were subpoenaed, and the public wanted answers. Chief Financial Officer Scott Sullivan was arrested and charged with securities fraud, conspiracy, and filing false reports. He eventually pleaded guilty and received a 5-year prison sentence in exchange for testifying against his former boss, Bernard Ebbers. Ebbers, who had always maintained that he wasn't aware of the fraud, became the central figure in the trial. The government argued that while he didn't personally cook the books, he created the culture that allowed it to happen, and actively pressured subordinates to hit the numbers at any cost. In 2005 he was found guilty on all counts: securities fraud, conspiracy, and false regulatory filings. He was sentenced to 25 years in prison. Ebbers' downfall was dramatic. He went from billionaire CEO to federal inmate. His assets, including yachts, were liquidated to help repay investors. His assets, including ranches, were liquidated to help repay investors. His assets, including luxury homes, were liquidated to help repay investors. In 2019 he was released from prison due to deteriorating health and died shortly after. His name now sits alongside Enron's Jeff Skilling as a symbol of unchecked corporate greed. WorldCom's collapse wasn't just about one company. It exposed systemic flaws in corporate governance, accounting oversight, and regulatory enforcement. Alongside Enron and Tyco, it fueled widespread outrage and led directly to the creation of the Sarbanes-Oxley Act in 2002. This legislation imposed stricter financial reporting standards, required top executives to personally certify financial statements, and created the Public Company Accounting Oversight Board to monitor audits more closely. The WorldCom scandal also served as a wake-up call for investors. For too long, flashy earnings reports and rapid growth had overshadowed basic due diligence. The lesson was clear. If something seems too good to be true, like billions in profits with minimal expenses, it probably is. Yet for many, the damage was already done. The fallout from WorldCom was immense and long-lasting. It decimated confidence in the tech and telecom sectors. It eroded faith in corporate leadership, and it forced both regulators and investors to take a hard look at the practices they had once accepted without question. Today, the name WorldCom is gone, rebranded, absorbed, and buried in the history books. But the cautionary tale it left behind remains relevant. In an era still grappling with tech billionaires, crypto crashes, and financial manipulation, WorldCom reminds us of the cost of corporate dishonesty. It wasn't just about dollars, it was about trust. And once that trust was broken, no amount of earnings reports or public apologies could fix it. If you found this breakdown of the WorldCom collapse insightful, make sure to hit that like button and subscribe for more real stories of finance, power, and the hidden truths behind the headlines. What do you think? Was this just bad leadership, or a system built to allow fraud until someone gets caught? Drop your thoughts in the comments.